originally.
Okay.
Been
Have you
over
ever
here
been
for,
to
oh yeah.
Pinner, which is near London?
I don't think I have. If I have, it was when I was very young.
Okay. Because my father-in-law is British.
Okay. I'm
Yeah.
from
So,
Shrewsbury. It's out near Birmingham or
okay.
Birmingham for the
Yeah.
Americans in the room.
That's,
All right. And we are now live. So, hello and welcome to anyone joining us just a bit early. My name is Charlotte. I'll be your Money Show host for this session. I do have Paul with me in the Zoom room. We are ready to begin his session on time at 3:25 p.m. That's Eastern Time, coming up in just a few short minutes. Thank you so much for your patience. I hope you're enjoying the show so far. Hello, everyone, and welcome to the session. It is my pleasure to introduce Paul Meeks, a widely followed tech investor and the head of tech research at Freedom Capital Markets. He's focused on the tech sector for over 30 years, including during major tech transitions, such as this one to AI and the next to quantum computing. Now, Paul regularly appears on media outlets worldwide, both in print and on air, and he is here today to share some of his expertise with us. So, to our live viewers, if you have questions throughout this session, please share them in the chat box. It's on the right-hand side of the video player there. And with that all said, Paul, I will hand the mic over to you. I'll be right here if you need me, but the floor is all yours.
Well, Charlotte and the Money Show crew, thank you very much. I'm honored to be here. This is fantastic. Now, as Charlotte mentioned, I have been a tech analyst exclusively since 1992, and I just did the math. That's 34 years. And of course, I have seen some things. And so I'm in the media a lot, as Charlotte mentioned, and I'm always asked, at least the last couple of years since the late 2022 launch of ChatGPT, is this a AI bubble? And is it reminiscent of what happened in the internet bubble, late 90s, early 2000s, that inflated very nicely, but like all bubbles, it popped? Where are we now in that timeline? So, as Charlotte mentioned, I work for an investment bank in New York City, even though I spend most of my time in Charleston, South Carolina. I'm the head of tech research for Freedom Capital Markets, and I'm also a finance and accounting professor, which I got into late in life at the Citadel, which is a military college here in Charleston. So, what I plan to do is give you my thoughts for about 25 minutes and then leave a few minutes for questions. And then also, as you may know, at 4:40 Eastern Time today, I will appear on a stock picking panel where I will match the names with this investment thesis. So please stay for the second half of the double header. So first of all, I think it's important to go through the agenda at least quickly, and I will just show you this slide because it extends over the page. What defines a tech bubble? I'm going to use some information from Professor Minsky, the stages where I think we are in this bubble. There is some science behind it. Also, a valuation deep dive. What do the valuations on private and publicly held tech companies and all those companies related to this theme as they are today versus what they looked like right before the internet bubble popped in March of 2000. I want to go through some of the stats because they are compelling for this surge in AI infrastructure investment. And what are the demand drivers and how durable they are, the key being how durable they are. And the next real driver for AI infrastructure build and for this entire ecosystem is AI inference as we move from large language model building to inference. This is a big deal. We have to be on top of this because this probably is, at least for the next couple of years, the greatest driver. Other things like Econ 1 will tell us there are demand factors and supply factors. And right now there's a voracious demand and not enough supply. We have some serious supply constraints, and I will identify them and rack them and stack them and tell you how important they are. Here are some bubble indicators that I will show you again during the inflation and popping of the internet bubble. I managed at the time for Merrill Lynch Investment Managers, which is now part of BlackRock, the world's largest technology mutual fund franchise. And so I saw it coming and going. And I learned some lessons from it that I will share with you today. I conclude, long story short, but I'll fill in all the details, that we are in perhaps an AI bubble. However, I think it's not going to pop anytime soon. And I'm actually only starting to get worried, at least in my forecast, in 28 and 29. So I am going to take a look at Dr. Hyman Minsky. Now, very interesting character. He was a famous, unfortunately past tense, American economist. He was a professor at the University of Washington, St. Louis, and he is best known for trying to predict economic recessions based upon the buildup of credit and borrowing here in the United States, not of the US government, but of the private sector. And so he also came up with a way to track this. And it's very interesting to me that he dies, unfortunately, in 1996. He writes his seminal work in 1986. So he has nicely tracked at least the internet bubble and probably this one too, and came up with a framework even though he passes in 1996 and doesn't even make it to the popping of the internet bubble. But here are Dr. Minsky's 5 stages. First of all, we have a displacement, brand new technology. AI obviously fits the bill, a game changer, a really big game changer. And I would make the case that it's a bigger game changer than even the metamorphosis that we had as we transitioned from different stages of computing to the internet world and then to the mobile world. You have a boom, which this is sometimes troubling, in private credit lending. And the reason we have this boom is some of these emerging companies are so risky that they will not be able to borrow from traditional sources like your commercial banks. And we are seeing right now a buildup in private credit. I think right now we are in stage 3. This is the euphoria stage. And not for all companies, but you start to see with some companies in the ecosystem a detachment valuation fundamentals. With some companies, not necessarily all. I think we probably are there now. I think you will start to see some profit taking as this starts to slow the AI infrastructure spending. But again, I conclude that that doesn't happen for a couple of years. So right now, I'm all in the AI infrastructure plays, which primarily at this point are semiconductor companies and some hardware plays. Once we reach an out of equilibrium situation where there is too much supply, the hyperscalers have spent too many hundreds of billions of dollars building this infrastructure, and there is not enough of follow-through demand. Then you have a plunge in prices and a flat ass panic. That's what we had in March of 2000. And as you may recall, from March of 2000 to October of 2002, the NASDAQ, the technology juice, went down 78%. And it did not come back and retest the high level for 15 years. But this is where I'm thinking we are in the cycle. Let me give you some more details. So one of the things that's important is we have to take a deep dive into the valuation. Now, this is the valuation comparison between the key publicly traded companies in the ecosystem during the internet bubble, 1999 to 2000, peak inflation, and let's call it the AI era. We really have started it just in the last year or so with the heavy AI infrastructure spending, even though OpenAI released ChatGPT in November of 2022. So I will tell you that right now, the metric that I like to follow the most is an enterprise value to EBITDA. An enterprise value in the numerator considers the debt value and not just the public equity value. And EBITDA in the denominator, think that as a surrogate of cash flow. The interesting thing here is most of the internet bubble darlings did not even have cash flow to measure this metric. Now we're trading at a 31 times, which is a pretty steep ratio, but think about it. In the internet bubble, 74% of these companies were not generating cash flow. Now, frankly, most of them are. So I'm actually pretty impressed with that. And I have a feeling of at least a bit more relief. Some people like to look at the price earnings ratio. I don't think it's really appropriate for an emerging technology here. But again, we are trading today. Some of these companies are still trading at close to S&P 500 like market multiples, where during the internet bubble, full inflation, it was double that. And take a look at the two darlings, one of the internet bubble era and the other one of today's era. The kingpin back in the late 90s, early 2000s was Cisco Systems. Now, Cisco Systems still exists today, but it's no longer a dominant company. They used to pitch themselves back then as the plumber of the internet, supplying all of the supportive gear. Today, of course, the bellwether is NVIDIA that makes the GPUs and dominates that market. So Cisco Systems, which was much less profitable and growing much more slowly in that period, actually got up to a peak of 472 times earnings. Right now, on a trailing basis, NVIDIA is at about 56 times earnings, but on a forward basis, NVIDIA is trading at only 24 times earnings. To put that in perspective, the S&P 500, much less profitable, growing much more slowly, trades at only one tick below 23 times earnings. And so the tech sector itself, was trading at a valuation back then of about twice the market. Now we're trading at about 30% more. Of course, today, if you invest in the S&P 500, maybe even through an exchange traded fund, you fully realize that 40 to 50% of the weight of even the S&P 500 is allocated to technology and communication service sector companies. And the communication service sector includes all your social media companies like Alphabet and Meta. And again, those companies that I used to see coming through my office and IPO roadshows when I was at Merrill Lynch, almost all of them. No cash flow to speak of, no cash flow to speak of for years. Some of them didn't even have revenues. Now, the share in this, chasing this theme in the AI era, about a fifth of those companies don't have cash flows or are building those cash flows. So it's much more reasonable. And one of the reasons is, and this is not new, in recent years, major companies stay private much longer before they do an IPO. And so they typically are much more mature and much more dependable and much more profitable and cash flow generative when they finally go public. So this is interesting. All of the spending, actually about 90% of the spending thus far on AI infrastructure the last couple of years has come from the hyperscalers. These are the big familiar tech companies, Amazon, Alphabet, Microsoft, Meta, Oracle, OpenAI, SoftBank, the Japanese company, Anthropic is coming on. Tesla slash SpaceX wants to invest in chips. And so these folks last year spent on capital expenditures, essentially to build and outfit AI data centers, $443 billion. This year, the same cast of characters are probably going to spend close to $700 billion. And take a look at my projection here for their demand over the next several years. We're going to get to a period conceivably where the annual spend is over $1 trillion with a T. And so the demand is here, and I will get into some of the drivers of the demand. I don't think it's a demand problem for several years. It might be a supply problem to satiate this demand, but I don't think it's a demand problem. So here are some of the demand drivers. We are building large language models like ChatGPT, OpenAI, Anthropic's Claude. But the big driver is as we move from training large language models to inference, we're actually trying to pull some apps out of the pipeline after all these hundreds of billions of dollars spent on training. Inference requires real-time input. It requires tokens or a measure of demand that are a multiple of what was required in the training process. So I think the biggest driver of all is that we've moved from training these models to inference, which has a demand for multitudes of higher compute. I think it'll be interesting to see the enterprises. When I talk about enterprises, I'm talking about businesses. So far, the hyperscalers have been carrying the load. I mentioned all those companies, but we're starting to see enterprises, businesses that are independently going to the neo clouds and the colo providers and actually directly contracting for compute capacity instead of going through the likes of Amazon Web Services or Microsoft Azure. Sovereign AI is up and coming. We keep an eye very closely, particularly on the Middle East, with some big plans there. And this will probably resume after the war in Iran ends, but obviously nobody can predict that. Science and research will be a nice use case. I think particularly the healthcare sector. The use of AI tools should really speed up the development of pharmaceuticals, and that could be a big, big market and really meaningful for a lot of people and their lives. And then there's going to be opportunities for clean energy, among other things, because obviously we're going to have to move from coal and nat gas to other forms of energy, whether you believe in climate change or not. There is a voracious demand and not enough supply. And so we will have to harness other forms of energy. And so we have some big use cases here. Enterprises that go up and down all the economic sectors in the US and abroad. The healthcare sector should be very interesting. Financial services is a nice fit for AI tools, clean energy, and more. And I really do think that of all these drivers here, what we're currently going through now, which has me seeing an explosion in compute capacity as we head into 2027, is this move from model training to inference at scale. So take a look at the inference market because it is my key demand driver. So we call this the age of inference, the age of reasoning. So you think about it, we have been building large language models. Now we are using them to generate revenue and cash flow with a variety of apps in those sectors of the economy that I've highlighted. And they need a lot of horsepower as they do real-time reasoning, thinking through problems, going through problems with multiple iterations. And so the inference market is very, very big. So right now, the inference market is probably 66 billion. And in only a couple of years, we expect this to magnify at almost $300 billion. So this is the opportunity. And then some of these AI models will really inflect, and you will love how these businesses look as we get out into 2027 and 2028. I mean, this is a 45% compound annual growth rate. And the nice thing about inference versus large language model training, which has brought us to the dance so far, is it's growing at least 2x. And so I am pretty excited about inference again. Out of all of my demand drivers, and there are several, this is the biggie. So here are some of the demand drivers, more specifically on a vertical or industry basis. We have seen software coding, huge productivity enhancement for coding agents. Some of the even most sophisticated software companies are saying that even today, about 40% of their coding is already done by agents, usually Claude Code. And I would expect more and more. So it's interesting to me that this is going to threaten traditional software companies, but it's also going to be a huge cost savings and efficiency boost for the very same companies. So are they going to be bit in the ass by AI, or are they going to be benefited? Hopefully, if they come out unscathed, it's going to be at least a neutral influence. But software coding has already shown its worth. Multi-step retrieval. I told you as we move from large language building to inference, multi-step problems, different iterations, sophisticated stuff. It's one of the reasons, because Claude is better than OpenAI at this, that a lot of market share is being taken by Claude from OpenAI, away from ChatGPT and to Claude Anthropic. And so, again, this is very interesting in areas like, let's develop pharmaceuticals. If we can develop pharmaceuticals faster and less expensively, this is a huge use case. But if you are doing deep dive research, particularly as an academic like me, These are terrific tools. And then we'll see what happens. There's going to be specific inference hardware. NVIDIA is developing systems. They just had their GTC, which is their annual conference for users, always very well attended. Everybody knows that the CEO of NVIDIA, Jensen Huang, is like the tech god at this point. He's the Steve Jobs of this age. But there are lots of opportunities. Now, when I build out AI infrastructure, the last couple of years, I've been staying away from software because I do worry that some of these companies will be disintermediated by AI. But I have been all in the semiconductor companies, the AI infrastructure companies that are building data centers and supplying their servers. And of course, NVIDIA is one of my picks. Come back at 4:40 Eastern Time. I'll tell you all the stocks that fit this theme. So here's the key. If you're a bear on AI infrastructure, which I am not, at least not in the near term, you think that we're pretty close, if not have already reached demand and supply. The demand is the pull for AI infrastructure, which is going to be led by some revenue and cash flow generating apps as we come through the inference period. And then the supply is how fast can you build these damn things? Sometimes it comes down to old school construction. But as you see here in my chart, the AI compute demand, I think I have that locked and loaded. I actually think that this might be underestimated. But take a look at it. The capacity, the supply to meet that demand is actually getting wider and wider, the gap. And so I don't see the demand and supply come into balance, which starts to get me worried about when this game is up, when this AI bubble pops, until we get to that 2028, 2029 timeframe. I actually think in the next couple of years, we will continue to upside capital expenditures. We'll start to see some AI use cases that give us confidence that there will be some return on investment. And this will continue to be very good for all of the guys that are supplying the picks and shovels to these AI gold miners. So here's my bubble meter. This is kind of tongue in cheek. And yes, I lived through managing the biggest tech fund on the planet Earth, the internet bubble, when it popped, and it was painful. I was on TV so much back then with people asking me about Yahoo and AOL and some of the tech companies of old that I would be asked for autographs when I was off camera. And then when the internet bubble popped, one dude wanted to kill me. And so I have seen it. And so I recognize the bubble. And I'm feeling pretty good about my view that this bubble doesn't pop for a couple years. Remember, I'm looking at that 28, 29 demand gets in balance with supply. But we'll see. We have a valuation stretch, but it's not as bad, not near as bad as it was in 99, 2000 before the internet bubble popped. We always have hype cycles, but I'm using Minsky's analysis, and I think we're at stage 3, euphoria, but not near the end of the road. There is some overcapacity risk, but I don't see that again until 28, 29. In the meantime, particularly not necessarily in 26 when we're still building out capacity, but 27, we will see after inference from a number of these companies some real revenue and some real cost efficiencies. And then people will say, okay, I get it. This is a good thing. AI infrastructure obviously leads to ROI, but so far, as I told you, 40% of our software coding is now done by Claude Code. So here's what I think. Maybe peak investment pretty soon. I think there might be some digestion of spending. So spending for AI infrastructure won't fall off a cliff, but it might start to grow at lower rates. And then, yes, we get out to 28, 29. There is the potential that demand closes that gap with supply and we have some trouble. But I think there's a lot to be made on these stocks in the next couple years. I'm thinking 2 to 3. So here's a couple of reasons why the pop is still a couple of years away. Committed capital. The guys that are spending are the hyperscalers, and they are the most financial worthy companies on the planet Earth. Sovereign demand, not just US demand. Other countries are seeing this as a competitive advantage for their nation state. competitive pressure, you do not want to be the guy that Meta smokes because they have capacity and you don't. Again, I don't think the supply can possibly overshoot for several years. We will start to see some productivity and ROI. And I'd highlighted a couple of use cases like financial services and the development of pharmaceuticals and healthcare, but new use cases are emerging for AI all the time. What could pop the bubble? You could have an efficiency shock. And that is essentially, oh, well, we spent this money and it just didn't work out. I don't see it. And that's related to there's no killer app. I actually think that the opportunity for that is, yeah, it could happen, but I'm not as that worried about it. Energy crisis worries me a lot. It's pretty easy to find land and to get permitting to build these data centers, which are enormous, but power is in very tight supply. So I look when I do my research for the companies that have contracted power, permitted power, all the state and federal and any other regulators all lined up. So power is precious. It's the most precious. I think it's the scariest thing that could pop this bubble. Regulation, I think we're okay. A macro shock and geopolitical escalation. Well, that's called the Iranian war. I am worried, not to tilt my hand on my political affiliation, but if this war in Iran continues for several months, we might have some permanent damage to the energy infrastructure globally, particularly with the oil and the gas that used to ship through the Strait of Hormuz. This could cause a problem. And if we have a recession in the United States in a response, obviously, even the big boys, the heavy spenders, Amazon, Alphabet, Apple, yeah, in a recession, you can expect them to trim their spending. So here's the way I come on it. Yes, we might be inflating a bubble. And remember, I was front and center as the last one we had in technology, but I don't think it pops. And if you were to put my feet to the fire, I'm saying I think we're good till 2008, 2009. And yes, you have some valuations that are out of whack with the fundamentals of some companies, but not all of them. Like I told you, NVIDIA is trading at a market multiple. The S&P 500 is going to grow its earnings this year about 15%. NVIDIA is going to grow its earnings 75%. So that's unfair. The demand is genuine, and it's backed by people with a real thirst to be first with AI infrastructure building because they see it as a competitive advantage. And that's all the hyperscalers, and the hyperscalers have the money to spend. I don't think we can possibly overshoot the supply for years. And I'm worried quite a bit about power being a supply constraint, and we have a supply problem, not a demand problem. And what I think happens is NVIDIA will grow its earnings 75% this year, then maybe 25% the year after that, but it's not going to drop. And I think if you are a bear on some of these stocks, you believe in this year's high growth rate, but you also think that it is not going to slow and still grow. You think it's just going to implode. I don't see that. I see a slowdown in the growth rate, but still a growth rate. And so I am pretty bullish. Come back at 440 or ask me right now. Man, I still like this thesis, and I have been contrarian. Right now, it looks pretty good for me, but a couple of months ago, I was the only one on Wall Street saying this. Sticking to my guns here today, too. So with that, if you have any questions, I don't know how I can access them, but I'd be happy to answer them.
Fantastic, Paul. Thank you so much. It seems like people might be saving their questions for that panel later. We had a few comments in the chat. People seem to really enjoy your presentation in general. They're wondering if, for compliance, if you're able to share that with us, we'd be
Yeah,
happy to send it along to those who were watching you live today.
yeah. What I would say, Charlotte, is yeah, please share the presentation, and on the cover of the presentation, you have my work phone number. which is a cell phone number, so I answer it. And you have my email address. If you have a follow-up question, happy to entertain them.
Fantastic. Well, Paul, looking forward to seeing you soon at the panel this afternoon. As he said again, that's 4:40 p.m. Eastern Time. We'll be back online with Paul and a few other experts for a great session. Thank you so much for your presentation today, Paul. It's been fantastic having you on.
Yeah. Hey, you guys love it and have me back. And please reach out to me.
Absolutely. And to those watching live, as we both said, be sure to stay tuned as we have more in store for you in this Money Show Virtual Expo. I hope you all have a wonderful day. Take care.